Good morning. My name is Sarah Ladislaw. I direct the Energy and National Security Program here at CSIS. Welcome to the Global Security Forum. We're very pleased to have such a strong showing here today. It's a very exciting day for CSIS, and very pleased that you could all be here with us. This is the Energy and National Security Program breakout session titled The Bulls, the Bears, and the Polar Bears, and Energy Market Outlook. We were actually really looking forward to this session because it combines a lot of the things that we've been talking about for a good period of time now. As we sit here in sort of midway through November, looking ahead towards the Paris climate negotiations, and well over a year, if not a year and a half, into a oil price decline that has lots of people talking about bullish forces and bearish forces in the oil market. What's a long-term trend, what's a short-term phenomenon, what's cyclical, what's structural. And we couldn't be more pleased to have the panel that we have here today with us to talk about some of these issues. Today, you have got, I think, hopefully their bios and their information in front of you, and we are running on a fairly tight time schedule today. So I won't go into too much introduction, but we've got Adam Sieminski, who is the administrator of the Energy Information Administration, Michael Cohen from Barclays, Mike Wittner, who is currently invisible, no, he's on his way. Mike Wittner from Societe Generale, who will be joining us in just a moment. And then Patron, who is the former director for energy and climate from the National Security Council and senior advisor to the president on climate and energy matters, who will talk a little bit, she's a polar bear, talk a little bit about not only the upcoming expectations for the climate talks and what they have to do with oil markets and energy markets near term and longer term, but also how some of these phenomena are reading into some of the expectations we have for longer term energy trends and dynamics. So today's session is on the record. I would just caution everybody, I know you're getting security advice every session you go to today, but in the event of an emergency here, please, the exit is to the back and left over there. Don't use the elevators. It'll take you downstairs to the alley out back, and you'll be able to convene out in the front green area. So we don't anticipate anything happening, but it's always good just to let people know. So without further ado, I'm going to let Adam take it away. Everyone's going to make some brief sort of 5 to 7 minute comments on their outlook for energy market trends, both near and sort of medium term, and then we'll have a bit of a discussion and then look to welcome you all into it. So thank you very much all for being here.
Okay. Sarah, thank you very much. Everybody can hear? Yes? Okay. So, the world oil markets in 5 minutes. Not a problem. What this is, using a very sophisticated thing called the Black-Scholes algorithm, and using options prices from the futures market for West Texas Intermediate crude oil, is that the price of oil, which EIA is forecasting for next year to be WTI, a little over $50 a barrel, and Brent prices towards the higher 50s, is that WTI could really be anywhere between $25 and $100. So, yes. So, and you know, the Nobel Prize was awarded for the Black-Scholes algorithm. It's pretty clever, and so what that says to me is $50 to $60 oil is the forecast, but you better have a plan B. Okay. Henry Hub natural gas prices, this is a similar view of that. One of the interesting things is that if you go back to April, the bottom end of the Black-Scholes 95% confidence range pretty much picked up where prices are. So we had U.S. natural gas prices falling towards the lower end of that range. The range for natural gas is just about as wide as we're seeing in the others. So, why did oil go down? Oil went down because in 2014 there was almost 2 million barrels a day of growth in U.S. liquids production, when world oil demand was probably going up no more than 1.5 million barrels a day, and probably closer to 1 million barrels a day. And that trend was going to continue if oil stayed at $100 or over. And so now oil prices have fallen, as I said, we're down closer to $50 a barrel. Look what's happening in the major shale producing regions, the Permian, the Bakken, the Niobrara, the Eagle Ford. Production is now falling at about 2% per month. That's what it had been going up by in 2014. So the seeds of a reversal in production have already sprouted, and the seeds of a reversal in oil prices back upward are being planted. So how long is it going to take? In our global balances, what we say is by the time you get to the end of 2016, the world oil markets will be in much better balance, supply and demand, than they are now, and definitely compared to where they were in the first part of 2015. So just keep in mind that Black-Scholes wide range of prices it is telling you that our supply-demand balances say it's going to get better, but it's the end of 2016. A lot can happen between now and the end of 2016. What would drive prices up? What would drive prices up typically is a geopolitical shock of some type that cuts off supply. What drives prices down is usually a slowdown in the economy, but it could possibly be a geopolitical shock in the sense of Iranian oil coming back in, and neither Russia nor Saudi Arabia nor Iran nor Iraq wanting to do much to cut production. So we're going to end on this slide, which basically shows EIA's longer-term forecast for the emissions of carbon dioxide from energy-related activities on a global basis by fuel out to the year 2040. So we are expecting continuing growth in the consumption of fossil fuels, mainly driven by economic growth occurring in the developing world. So a lot of this growth is going to be in places like China and India. So Michelle will talk more about this, but in the run-up to Paris, it's going to be very important to have more of a global approach to finding ways to do this, because the problem is a global one that's not going to be easily solved by any one country alone. These numbers come from our 2013 International Energy Outlook. We'll have a new version of that out, possibly at the end of this year, very early next year. I think we'll call it the 2016 Outlook, but the numbers will shift around a little bit because we're going to have slightly different numbers for coal, maybe a little bit lower given some of the regulations that are already in place and being talked about. But the overall growth in carbon dioxide is a track that we're still on, absent further changes in law or regulation. So Sarah, thanks very much. I think I stuck to my time, and I'm delighted to hand this over to Michael.
Thank you very much.
Thank you, Adam, and thank you everyone for inviting me here today. It's a pleasure to speak to you. A pleasure to be back in Washington, D.C. I want to go through a couple different slides, both on the short term, but mostly on the medium term market. I don't differ very much from some of the points that Adam made in terms of us not really seeing a tightening of the overall oil market balance until the last quarter of 2016, where we expect, based on our balances, to see the first draw in stocks. So we do expect that the market will remain range bound and see some opportunities for prices to rise. I think a lot of that depends on whether you believe that some of the Iran incremental oil that's expected over the course of this next year is already priced in or not. So that I think is a point of contention among some analysts. But I don't want to dwell too much on the short term, because I want to try to take a bit of more of a medium term perspective. And so to do that, I want to show this chart, and I want to try to explain how this cycle has differed from last cycle. So you can see here the juxtaposition of non-OPEC supply growth along with prices. You can see that at certain points in time, we've seen the perception, along with fundamentals, are driving the market. That's not new. It's just that, you know, during 2008 and 2009, this was the era of peak oil, and no matter what was happening necessarily fundamentally, we saw prices continue to move up. And we're in a similar kind of situation right now, where this perception of a glut is also keeping prices from being able to make any headway back up. So the other difference right now is that we have OPEC and Saudi Arabia that are seen by the market to not be reacting. And there's no real credible path to a cut going forward. So we don't expect that OPEC meeting next month will actually make any kind of credible statement in an official communique to address this imbalance. And I think the broader reason for that is that it comes back to the question of whether this is a reaction to a oversupply or a demand or supply shock or a demand shock. And at this point, as long as the perception is and the interpretation by OPEC members is that it is a supply shock, then the best course of action for them is to do nothing and let the market eventually react to that imbalance. If it does emerge that there is a demand shock, then we would expect that OPEC and other countries would react to that with some kind of credible path forward, as they have in the face of every other demand shock that we've seen in the past. The other difference between now and in the 1980s and late 1990s and 2008, 2009 is that we have this alignment of key macro issues. So we have zero to negative real interest rates, a host of emerging market credit issues in anticipation of a Fed rate hike this coming year, and we also have this very, very strong dollar strengthening that has basically created a lot more extra volatility in the market, and it's also created this extra period of uncertainty that was not present in the other cycles. So where does this put us for the coming year? So as prices remain low, the existing supply is declining, and it's natural for that existing base to decline. We calculate that it's declining at around a 3% rate per year. You have older vintage wells and older vintage supply that it's declining at a less steep rate as part of the way that normal fields look and decline and behave. And then you have more recent fields that have come on that are declining at a slightly higher pace. Of course, it also depends on where those fields are located. Sometimes you've got them in the offshore that are declining more quickly, depending on whether they're in OPEC or non-OPEC. You have a whole host of different decline rates, and we think that the market's not really understanding how those decline rates are reacting to this lower price level. So looking at the supply excluding shale, you can see this in the chart on the bottom right. You can see that about 8 million barrels a day of new production was needed just to offset those. To invest, given that price. And so at this point, we're looking at a period of time right now where capital expenditures by international oil companies and by U.S. companies is declining very steeply. This year we expect it to be about 20 to 30%, and next year again 20 to 30% of decline, at least expected for capital expenditures. So what do we see in those periods of time when capital expenditures are declining? We see an acceleration in the decline rate at existing fields. So you can see in a couple instances in this chart that it's happened in the past, and we expect that it's happening now. Why doesn't the market understand this, or why aren't people seeing this or talking about it more? The reason we believe is that the data is not good enough. We don't have field level data to really indicate in all places over the world where this is actually happening. So you can look at a place like the United Kingdom or Norway. We have field level data. In the US, we don't have field level data. In Brazil, we have field level data. In Mexico, we have field level data. And if you look and peel back along the edges, you can actually see that in those places, the decline rates are accelerating. So we expect that to be an important component of the rebalancing process that's expected to take place over the course of this coming year. And so the question then becomes, well, given that this is happening, how quickly is it happening, and how quickly is it happening with reference to the amount of demand growth that's occurring? So what we did is we constructed a couple scenarios, and we said, well, in a baseline scenario, we're expected to see another 4 or 5 million barrels a day. We expect that the decline rate is going to be accelerating, and we expect that tight oil will have to be able to pick up We have other exogenous sources of supply, or sources that are not really reacting to what's going on below ground, but are more reacting to what's happening above ground. So we constructed a scenario, and in that scenario, you have both the price elastic supply in North America and price elastic supply outside of North America that are reacting in different ways to the price. Price allows you to meet that extra demand that is going to take place from now until 2020. So in that scenario, we expect the prices are likely to range back up into the $80 range by 2020. And I'll come back to that idea in a moment. But first, I want to just focus more specifically, because the organizers asked it, on North American supply. So in theory, the elasticity of tight oil supply in our model is expected to be much more reactive than other sources of supply. We've seen that a number of different things have happened over the last year. We've seen horizontal oil-directed land rates down 60% since November 2014, but U.S. supply has basically not done anything at all. We're still averaging about 9.5, 9.3 million barrels a day based on the latest statistics from the EIA. But when you look even back there and look at what's going on just in the onshore, there is some decline that we can see. But basically, this idea that we should have seen shale oil act as a balancing mechanism is not really true yet. And so why is that the case? We're over a year since the beginning of these price declines, and so the elasticity of tight oil supply is basically, in theory, non-existent at this point. Yet, of course, capital expenditure is down, rig count is down, drilling activity is down. So we've seen U.S. producers extend the laterals. We've seen the IP rates, the initial production rates increase. We've seen efficiency gains and higher overall resource availability. We've seen a lower spud to sales date, so that means that they can drill and complete and get the oil to market sooner. Number of frac stages per day. All of these things are all facilitating U.S. producers being able to weather this storm. So we will see an effect, and I think one of my most favorite statistics is that for all these companies that are reporting, they only represent about 50 to 60% of total U.S. production. So there's a whole host of other production that's not being reported, and that's why we rely on statistics from EIA to try to help us fill in the gaps of what's going on. The other thing that's going on right now is that the hedges are still in place. So right now we have an estimate of about 15 to 20% U.S. companies are hedged, 15 to 20% for the year ahead. In the past, for the year ahead, U.S. producers have been hedged in the range of 20 to 30%. So they're relatively unhedged coming into this year, and that's going to affect their ability to continue to spend at the rate that they have in the past. So just to conclude, what is this price that's going to be needed to basically ensure that shale is additive to growth and not a drag on it? Because the concept that shale needs to be additive along with mitigating the decline from other existing supply is one that we think will move the price up higher from where we are right now. So since this slide was made about a month ago, of course, we've seen prices continue to come down and the curve continue to adjust down another $1 or $2. So it's not 65 in 2020, but it's probably somewhere in the range of 62 to 63. But I think that to just conclude here is that under any demand scenario, even in a scenario where we expect only 500,000 barrels a day of new demand growth for 17, 18, 19, and 20, you still need to have price price be higher than where we are right now in order to dispatch sufficient shale oil to the market. But until that expected reduction in supply occurs this year, the market is going to continue to price supply out of the market. And it's only when things begin to turn that people will think, well, price needs to move higher in order to dispatch additional oil to the market. So when the turning point is for that shift is going to obviously be a function of perceptions and fundamentals. Perception of the first draw that could even take place as soon as this quarter, Q1 in 2016, but likely not until Q4 2016 is one element to that. The additional volatility and bearishness in the new year as the market digests the pace of the Fed rate hikes is going to be another key issue. As the dollar continues to strengthen, we've seen the price of oil react to that as well. So in our view, the recipe would be a backwardated curve, continued presence of geopolitical risk, and a tightening of the market balance is what's going to turn the market around so that it begins to look at what this scenario is showing. So I'll stop there. I'm happy to take your questions.
Sorry for being late.
Sorry for being late. I'm one of those stupid people that got stuck in a taxi and had to get out and run. Anyway, very glad to be here. Just gonna share my next slide. So, Sarah asked me to do a couple of things. I guess I'd like to give you our view on the short term, the 1-year outlook, and also the 5-year outlook, but also to try to frame up the what the issues are. You know, what are the points of contention that really divide the bullish people from the bearish people. I think what Adam and Michael have said here today, we're generally in disagreement. I think most folks in the markets, whether they're analysts or oil companies or investors, most folks in the markets pretty much agree on what the dynamics are, what the moving pieces are, but there's differences in the timing, there's differences in the numbers, and that is really what drives, I think, the different views that are out there. So on the short term, for next year, we continue to believe that this is primarily a supply-driven market. The structural change in supply driven by U.S. shale oil, that's what the Saudis reacted to a year ago. That's why they changed their strategy. You know, it was a structural shift requiring a long-term strategic change. So this was about much more than the usual inventories going up and down. Let's make some short-term reactions. So that's why we are where we are today. Our short-term view is that the oversupply, and I don't think this is that much different, the oversupply, bottom line, compared to where we were 3 months ago, and when I say we, we're talking about the markets in general, compared to the general perception and reality compared to where we were 3 or 6 months ago, the oversupply is lasting longer than we thought. The U.S., as we just heard, the U.S. production situation is more resilient, even though U.S. production is declining and has been declining for several months, as Adam's numbers show. The market says, yeah, but it's not as much as, not as quickly as we thought. In addition to that, OPEC production, I mean, particularly in the short term when everyone, I think, has expected the U.S. to be the first mover on the supply side because of the very steep decline rates in wells, down 70% in the first year, very small, very nimble companies compared to the international oil companies. We've all been focusing on that, but sometime around mid-year, it kind of snuck up on everyone that Saudi Arabia and Iraq had each increased output by, at their peak, about 0.8 million barrels a day. Big numbers, very big numbers. In other words, when they talked about not cutting and letting the market do the job, this wasn't a passive strategy of we're not going to do anything, let the market do the job. It was an active strategy. When they talked about increasing market share, they went out and got it. All right, so again, it's not just about watching the U.S. come down slowly, and that will be gathering pace, but it's about the OPEC production, and that's a big reason why the rebalancing is pushed out. We think the rebalancing, in other words, stock draws, that's what we mean when we use that word, not really going to happen until 2017. 2016, in the second half of the year, we start to see some light at the end of the tunnel. And by that I mean inventories simply stop going up. But how bullish is that? That's debatable because we'll stop going up, but we're going to be at very high levels following 2 years of uninterrupted pretty much uninterrupted stock builds. So that's maybe, I'm kind of weighing that. Some people say, oh, the fact that we see some OECD draws, as you can see on the chart there, is real bullish. We see that as a bit constructive, but that's why maybe we're, I'd say, a little bit below average on our price outlook. And the other thing, of course, as the others have talked about, is Iran coming back. It's a huge wild card. I'll come to that in a second. But that's another element of the oversupply. Big picture, though, the U.S. Declines do gather pace. The U.S. leads an overall decline in non-OPEC production, so next year. And again, where we are now, even though we're in the midst of another downward wave, we're having these ups and downs, and the bottom line is we think that the market's prices have found a level, have found the price range that is low enough to cause supply to go down and also to encourage demand. And I think that's, everyone talks about lower for longer. It's a nice slogan, it fits on a bumper sticker. What does it really mean? That's what it really means. Prices need to be low enough to encourage demand growth and see supply go down. So that's, based on that, we have prices essentially flat next year, annual average, about $54 for Brent, about $4 or $5 under that for WTI. The other thing, and I'm now going to get into the next one, which is sort of what's driving all these perceptions of the bullish and bearish in the short term. Well, the first one, that's the last bullet on the last slide, is one of the big differences between the U.S. as the so-called swing producer, the de facto swing producer, the big difference between when the U.S. plays that role versus the Saudis playing that role is when the Saudis wanted to, and again, as Michael just explained, it is taking a lot longer than people thought. But putting that aside, the big difference is when the Saudis wanted to increase production up or down, Ali Naimi picked up the phone and it pretty much happened the next day or the next week. Whereas when the U.S. does it, you have a couple hundred companies, each acting on their own in response to the market, in response to their stakeholders, in response to their own balance sheet, and it's a very messy, ugly, long, drawn-out process. Okay, so in addition to all the details of why it's been so resilient, which we started getting into, it's just by definition, you have many players and not just one. So it takes longer. And the market, I think, has taken a long time to really grasp what that means. As I mentioned earlier, I think most people agree on the dynamics of the outlook, which is U.S. shale is going to come down, it's going to drive non-OPEC to a contraction. The markets are going to rebalance sooner or later. The devil is in the details, and that's where you have a variety of views on the price. On the bearish side, people will say U.S. supply didn't start declining until April or May. Production costs have been declining. We think they're down around 20% this year, from 60, 65 a year ago down to about $50 for U.S. shale. That's the center of the range. We have this OPEC surge. There's huge disagreement on Iranian volumes, how quickly they're going to return. Sort of the consensus view, most people say, sort of in line with what the U.S. government has been saying, that the whole process is going to take about 6 months from last month until sanctions relief, and then we're going to get this gradual return. But in reality, that's a nice central case. But in reality, no one really knows with a high level of confidence. Okay, so it's going to be a source of uncertainty for the market and a source of volatility. Another bearish thing, we got a wave of this earlier in the year, sentiment-wise, and we're in the middle of another wave now. Markets are concerned about stock builds causing inventories to reach tank tops onshore. If you start to run out of storage capacity on land, that's a very bearish situation. On the bullish side, I'll repeat the same bullet as on the bearish side. U.S. supply has started to decline. So ultimately, that's pretty much a very strong case for a short-term rebalancing to at least start to get underway. And that really is what's underpinned prices. Number two, we've had very strong demand growth this year, much stronger than expected. primarily driven by the US and China, primarily by gasoline. That's probably not going to be repeated, but it's been a real source of support for the market, even as markets have been concerned about China and other emerging markets. There's a lot of risk out there, but the fear, the headlines is not the same as the reality. And I'd even go a little bit further and say in the last 1 or 2 months, it looks like U.S. demand is starting to, the rate of growth is starting to ease off a little bit, and the same for China, based on preliminary numbers. But is this something to get all worried about? No, in our view at least, it's sort of the downshifting that we expected. Because I don't know anybody out there who expects another 1.8 million barrels a day demand growth next year. The numbers are 1.2, 1.3, 1.4, higher. I wasn't going to mention it by name, but since you did, yes. But other than that, there's not many people saying that. So, we're going to get, in other words, if you believe we're going to settle into a little lower pace of growth, we're going to get some downshifting anyway. So, is this something that's particularly bearish? Maybe, but in reality, we all expected it, or many people expected it anyway. So let's keep it in perspective. On the geopolitics. Oh, last but not least, on the bullish note, again, as we already mentioned, we have had huge cuts in spending. Down 40% this year. We think in the U.S. a little bit less out in the rest of the world. We think in the U.S. it's going to be another 30% next year. Again, continued cuts in the rest of the world. Rig counts have come down tremendously, not only in the U.S., but also in the rest of the world, going to your point about decline rates. So all of that is very bullish. So there's definitely something going on. So even when you see all these bearish headlines and bearish developments, and oh my God, what's going to happen in China, you know what? This supply is reacting. It must, and it has already started to. Okay. On the geopolitics, we have Yemen, we have Iraq and Syria. To be honest, the oil markets seem to be pretty calloused to all the various developments on the geopolitical front, but there are real risks. The interesting point is that once the Iran nuclear talks reached a successful conclusion, you actually took an unusual event out of geopolitics. In other words, that was unusual because most of the time we talk about geopolitics, it's bullish. We're talking about a supply disruption. Iran had been a bearish geopolitical event. Now that's sort of out of the abstract and it's in the balances. So now we go back to a more normal state of affairs where geopolitics going forward is going to either be neutral or on occasion bullish. On the non-fundamentals, it's worth reminding ourselves over the summer we had the huge drama, or maybe tragedy is a better word, with Greece and the Eurozone. That seems to be put to bed for now. And also, last but not least, we have constantly changing expectations about what the Fed is going to do with rates. And in the oil markets, stronger rates lead to a stronger dollar, and a stronger dollar, we have an inverse relationship with crude prices. Okay, so now, once again, we're back to a situation where the market expects a rate of lift off. So, but again, the point is, as you guys see all these headlines and read about this in the paper, these changing expectations do have an impact on the oil markets. In the medium term, I think the medium-term outlook, you can really boil it down to one key question. If you assume, and I'm starting out with something that I know in a minute I'm going to say is debatable, but if you assume a consensus type of economic growth, and I tried to pick a demand growth somewhat in the middle, maybe it's slightly to the low side. If you assume the oil demand growth of 1.1 million barrels a day, some people have it as high as 1.4, 1.5 over the next 5 years. The IEA in their World Energy Outlook last week had something as low as 0.9 million barrels a day. I don't want you guys to get hung up on the numbers here. The concept is the key thing. If you believe in sort of a middle-of-the-road demand growth forecast, the question is the following. If low-cost Middle East crude, which is, say, 10 to 25 bucks, And if middle cost U.S. shale, which is 50 to 60, remember I'm on a Brent equivalent on this table, so as I said, we think it's around $50 on a WTI equivalent. If you believe that low-cost Middle East crude and medium-cost U.S. shale on their own can meet demand growth, then prices are going to stay where they are. That's a bearish outlook, okay? On the other hand, if you believe, hey, those two buckets of crude, of incremental growth, won't be enough to meet demand growth on their own, that we're going to need expensive deep water offshore from places like Brazil, and we're going to need Canadian oil sands, then we're going to have to go back to a $70 to $80 world, because that's what those projects need to be incentivized for companies to take them forward. And our view, and it sounds like my colleagues here, is that we will need those expensive sources of oil. So sooner or later, the markets need to. They must go back up to that sort of price range. By the way, in the table here, it's a lot more complicated than this, right? You do have decline rates. I'm just picking out some highlights of countries, of individual countries where we do expect growth to return. And by the way, that US, that 500 KBD, that's total US, and that's total liquids, that's crude and condensate. So it's not really that rapid of a growth rate. So just to wrap it up, and I'll pass it over to Michelle. That one key question, it is a very simple question, but again, it includes everything. So it means you can debate the economic outlook, you can debate the demand growth outlook, you need to get into the nitty gritty of supply in all different places around the world. You need to actually think about cost trends, not just what costs are now, but what's the trend going forward. An important point here is historically, if you look at all the major price cycles going back to 1986 to the mid-80s, prices always follow costs. They follow costs with a time lag. So if we're right that we're kind of roughly at a bottom for prices and they start to stabilize and then grind higher, maybe starting in the second half of next year, the cost decreases are going to come to an end. And that's very supportive for prices, because that's ultimately what sets the floor. Last but not least, I mentioned geopolitics, and you're going to talk about the environment. On the Saudis, the big question is, are they going to be hands-off forever? Or are they going to resume a more active market management role? The very bullish interpretation actually is in the long term, if the Saudis are hands-off forever, they let the market do it on their own, then you are setting the stage for a price spike. Then you could go back to $100 because you're going to get this huge mismatch with the oil companies canceling projects, and all this demand's doing its thing, and then we're going to get into a period of big tightness. We believe that's not going to happen because we believe that actually the Saudis and OPEC are not dead; they're just taking a nap. That basically, when it looks like the oil markets are starting to set up for a period of tightness where prices are setting up to surge significantly above the $70 to $80 range, that's when the Saudis will want to start investing in capacity and then following that with increased production, because they don't want to see prices go back to 100 because it didn't work out too well the first time around. We got too much supply and not enough demand. So I would end it there.
With Michelle, focusing on the climate deal and what that has to do with energy markets.
Great, so thank you CIS, thank you Sarah and Frank and the entire energy team here who does an amazing job covering all of these issues. So I'm going to talk about the upcoming meetings in Paris on climate and what that could mean for energy markets. In just over 2 weeks, you'll have world leaders convening with climate negotiators in Paris to cap really 4 years of negotiations on a new global framework to address climate change. And unlike past meetings, there is actually momentum building for action and frankly a consensus emerging for global action. In many ways, the heavy lifting for these meetings has already occurred. You have 150 countries who have submitted national plans saying what they think as a country they can do in the energy sector, in the transportation sector, in the forestry sector, in the agricultural sector over the next 10 to 15 years. And these plans cover, as the chart shows, over 91% of global emissions, and they include developed and developing countries. They include energy producers and exporters, energy importers and consumers. They include folks with market economies and regulated economies. And this is really a shift from the past. It's a bottom-up, flexible approach where countries themselves come forward, and it's not a top-down straitjacket. And what a Paris Agreement would do is it would tie these plans together and create a regular process for countries to track, and the rest of the world to track the progress of each country against their goal, and a framework to attain that goal, both over time for future dates, but also the existing goals. And so there's still a bit of work to be done, and if the countries are able to reach that kind of agreement, the importance is that it will, one, send a very powerful political and market signal that all countries are taking action and that there is a fundamental shift of how we produce and consume energy. So what does this mean? The most immediate impact is on the power sector. And I talked about those plans that countries put forward, and almost all of them focus on the power sector. That's where most of the near-term action is. And what you have is an extension and, frankly, acceleration of recent trends, shifting the power sectors away from coal towards non-fossil. The International Energy Agency in Paris put together an outlook based on these plans. And this is what that chart shows you, that in the power sector, they're forecasting a decline in the share of coal in power from 41% currently to 31% by 2030, just under the plans, no tightening of those plans. And on the other hand, you have non-fossil, which is renewables, solar, hydro, wind, nuclear, going from 32% of the power sector in 2013 to 44%, a really sharp increase. And if you read into the numbers a little bit more, what they say is 7 out of every 10 power units that will be put online in the next 15 years will be low carbon. And we're already seeing that trend in the 2014 numbers, where you had 45% of all of the new capacity in renewables alone. So this is the most immediate market shift that you'll see. If we turn now to the oil sector, the impact is much more nuanced. My colleagues focused a lot on the supply side of the equation, but this has the potential to impact very dramatically the demand side of the equation. In the short term, what a deal in Paris and consensus and will mobilize is a doubling down on vehicle efficiency improvements in both developed and developing countries, and not just the passenger piece of this, but the heavy-duty vehicle piece of this, which consumes a lot more accounts for a lot more of the transportation side of things. It could also allow for an acceleration of fossil fuel subsidy removals, which also acts to depress demand. And those things can happen pretty quickly, especially on the subsidy removal. You get the demand impact pretty quickly. And if you think about what my colleagues said about how in the next 18 months, we're still in this delicate situation in the market where you're really counting every barrel on the supply side to get you back into a price growth pattern. If you have additional demand reductions, that could definitely affect the balance. In the medium term, one of the levers in the oil markets will be international action on aviation fuels and marine fuels. There are 2 UN bodies that are looking into this, the ICAO in the aviation and the IMO in the marine side, and a strong agreement in Paris and moving ahead by each country in this area could also give momentum to the discussions that are happening there for global controls on those type of fuels. You also have carbon markets, which some of them are already in operation in Europe, but others that are entering into operation in Korea in 2017, in China. They'll focus initially on the industrial and the power sector, but over time could also include pieces of the transportation sector. And probably the most important piece of this to watch is the long-term impact on the transportation sector. So a very solid, strong political and market signal from Paris can boost investment by both the public and the private sector in transportation alternatives. If it's in storage, if it's in electric vehicles, if it's in hydrogen, and that can dramatically disrupt demand in the future. And if you think of the orders of magnitude that my colleagues were talking about, 1 million barrels a day potentially coming back from Iran, 2 to 4 million barrels a day of U.S. supply in either direction, even 8 million barrels a day of over 10 years on, or 5 years on the decline. This we're talking about the heart of oil demand, which is in the tens of millions. So that is what really, and you look at the forecasts that are out there long term, and an oil price recovering to 85 and going to $100 a barrel in 2020 does not build any of these scenarios there. That doesn't mean that these scenarios are the most likely, but they can be extremely, extremely disruptive. There are also potential impacts on the supply side. So there is all agreement and momentum coming out of Paris can also encourage countries to double down on controls on methane. Methane is a gas that is produced alongside oil sometimes and tends to be flared at the wellhead or leak throughout pipelines. And if you have tighter controls, that can increase the supply costs. The other wild card out there is a growing movement on stranded assets. So there is pressure that's building by groups on companies to abandon environmental risky supply side investments. We saw that take root during the Keystone debate over the last 5 years here in the United States, also in the Arctic drilling, and that also, one, has the potential to increase supply costs, but it has also a micro impact on each company's portfolios. So lifting up, the most immediate impact will be on the power sector, but frankly on the oil sector, you have an extremely wide range of uncertainties that climate brings, which really dwarfs a lot of the geopolitical and supply side, and is something that both companies and investors are going to be paying a lot more attention to in the years to come.
Thank you all of you for a great set of comments that really do bring us sort of from the short-term sort of outlook to the long-term outlook, which Michelle presented and each of you touched on. We've got a bit of time for discussion, and then I'd like to open it to the audience for questions. One of the things I'd like to sort of pull on that each of you have touched on, but really haven't discussed explicitly, is when you look at a range of energy market forecasts, whether they're coming from in environmentally constrained scenarios, Michelle just talked about, to just the range of the bullish and the bearish forecasts, which Michael and Mike talked about really well. There's sort of this tendency both among energy analysts and I'd say security planners as well to try and always learn from the last war, right? Learn from the last incident. And we do have this in energy analyst world, this sort of phenomenon as well, which Mike alluded to, which was, gosh, what is this downturn like in the oil price cycle? Is it like the 1980s? Is it like the early 1980s, the mid 1980s, the late 1980s? What can we liken this to? And what you've seen is a proliferation of writing or some themes coming up in different people's perspectives on the sort of price downturn we find ourselves in today. Is this a cyclical phenomenon or is it a structural phenomenon, and how can you tell the difference and when, right? So anything from what Michael was talking about, which he's gone on at length in some of his reports, is how much is tight oil a swing producer, and how can we know, and what are the supply elasticities of that kind of production, and what can the existence of that kind of production do to the market dynamics longer term. You also have this, longer term question of this, the inflated position of some of our global stocks, right? Some of your colleagues in other firms have basically asserted that those stocks positions could stay inflated for a period of time, much different from a period in the past, and maybe that adds a new and or different dynamic to the market longer term. I'm really glad that Michelle brought up some of those underlying features in the long term about what the erosion on the demand side is, because while everybody sort of pointed out that the demand response has been one of the sort of bullish dynamics in this market structure. It's not as bullish as the surprise, quote-unquote, demand that we've been seeing from China over the last decade, and maybe understanding the growth of oil demand going forward in the medium term is something that we need to get sort of a better handle on, especially as we move into the longer term, and this kind of demand is coming from places where we have less and less reliable and real-time data, that's going to become an increasingly important feature in the market. And then finally, something that was just sort of alluded to but not talked about in great depth is sort of the increasing role of sort of financial instruments and financial players in the market. We'll be looking at it sort of in this period of time where we've had, significantly low interest rates for a long period, largely seen as being able to give tight oil producers in the United States a fairly lengthy leash to keep producing and improving, even if the price signal didn't look like it necessarily supported it. These are all sort of dynamics that you all touched on, but I wonder if any of you think about them in terms of being something fundamentally different from the past that is a setup feature for a new oil market or energy market dynamic that people are really only coming to appreciate. We've seen a lot of people writing about sort of the new economics of oil or the new oil dynamic or those sorts of things. I just wondered if you could maybe each, if you want to touch on something that you think is fundamentally different now from the past, or if you do think this is very similar to situations we've seen before. Adam, do you want to start with you?
Okay, that was a lot. Is this different than the last time? Well, this is the first, usually oil prices fall when there's a big recession. And this time they fell because of a supply problem, not a recession. So that's different. And I think both Michael said that this was a supply problem that needed to be solved on the supply side and probably wasn't going to be solved on the demand side. And I agree with that. So let me move on to demand. It's possible that demand has been higher. We've been doing some work at EIA trying to combine more timely market data like the MasterCard series of information on gasoline sales with EIA's own models. And what that shows is maybe over the summer, gasoline demand might have been 9.6 million barrels a day instead of 9.4 million barrels a day. So a couple 100,000 barrels a day higher. And I agree that it was probably gasoline. We probably didn't have oil demand going up too much in industrial uses and elsewhere. And if you said, well, maybe something like that was also happening in China or in Asia generally, so 300,000 or 400,000 barrels a day, more demand than is in our official supply and demand model. That's nice, and that's beginning to move you towards market balancing, which we see happening. Everybody worries me that everybody seems to think that it's the second half of 2016. But that growth in demand isn't enough. You're talking about a several million barrel a day oversupply of oil that's got to be solved on the supply side. And one of the things that might slow down the supply response, and Mike Wittner said that it seemed as though, was it Mike? It said it took longer to rebalance supply than most people thought. So why is that? Well, the conventional equity and conventional debt financing is kind of drying up, but the private equity people seem to have full pockets and are looking for ways to invest some of that private equity back into the oil area. And just to be clear, when oil prices fall, the oil in the ground doesn't disappear. The company that was producing it might disappear, but somebody else can step in and buy those properties at lower prices and possibly make a go of it. So I think all of that explains why, absent some big geopolitical loss of crude, why the expectations of both people in the market is that this is going to take a while yet to rebalance.
Sure, just a couple of things to add on that. I think going forward this year, the other thing that needs to be paid attention to is this issue of crude quality. So one of the issues in delivering WTI oil, no one really knows what kind of crude is sitting in Cushing. So when it comes to periods of refinery turnarounds up and down, there's the potential for both prices to go down and prices to go up depending on what is actually available there to be delivered. So that's one issue that needs to be addressed. The other issue is that on the upside, we talk about elasticity as a result of prices going down, but what about elasticity as prices go up? So, well, if we assume that coming from an area of $40 a barrel going up to 50, that's going to be sufficient to dispatch, 500,000 barrels a day of oil out into the future, I think we have to question what kind of cost adjustments have been cyclical and what adjustments have been structural. And so what we assume is that it's about a 40 to 60% split, so that you have some issues that companies have been able to permanently improve their frac design or the amount of proppant that they've been able to throw at different wells, or they've been able to employ a bunch of new technologies. Those are structural. But then the fact that some companies have been able to take advantage of a slack in the labor supply, and that they've been able to therefore see the advantage of less demand for services, that's something that is more cyclical. So when the market begins to respond, you're going to have a reaction, and you're going to need a higher price in order to pay for those services that are charging a higher rate. So, I asked an independent producer the other week about this issue. He said, well, look, I've talked to some of my companies, or some of our completion crews. Could you get a whole bunch of new completion crews out into the Bakken or into the Eagle Ford to ramp up production if prices went up $10, $15? And he said, no way. So that's the thing we have to understand here, is that it's going to take a higher price level for a sustained amount of time, and in the meantime, it's going to come at the cost of Minister Naimi saying, yes, we need to add another 500,000 barrels a day to the market, thus reducing the overall spare capacity in the market. So there is the potential for surprises, both on the upside and on the downside. The other thing that I think is relevant in this issue is that in the IEA's World Energy Outlook that they released last week, one of their key points is that the technology and that the learning that is taking place is not sufficient to offset the fact that companies are going through their best assets right now. So they've already gone through this process of high grading, and they're producing from their most productive assets, and they're using their A-team, their most efficient completion crews out in the field. And so therefore, when we cycle through those most productive assets, it's going to lead to a higher cost of production. So that's just something to keep into account as we try to think about all the different ways in which companies are adjusting to this lower price level. The issue of financial players, I think it's probably best for me not to get into, but it is an issue in terms of how the curve is structured. We see you definitely have this issue where certain players are more incentivized to be buying and selling contracts out into the curve, and other sets of mostly consumers that really see no real incentive to take the other side of that contract, namely airlines. It is a question of whether shareholders are actually rewarding some of the companies that have traditionally been a key part of that trade. They're not really being incentivized at all times, or at least in the same way as they were in the past. And so that leads you to a point where the futures curve is not necessarily a great predictor of future price levels. So.
Yeah.
You guys have covered a lot of ground. A couple of things, a couple of thoughts come to mind. One, going back to what you mentioned at the beginning, I sort of alluded to this earlier, but again, what is different about this cycle versus 2008, the short cycle we had after 2001, 98, it's not since the mid-80s that we've seen a cycle like this where you don't have OPEC and Saudi Arabia and the others sort of acting to try to manage the supply side. Not that it was always perfect. Again, the Saudis and OPEC essentially can manage, when they do manage, back in those days, they managed incremental sour supply. They didn't manage sweet supply, and they didn't manage the global economy or product demand. But it was one important piece. So I think it is important to remember, to me, that's top of the list, why this cycle is different from the last couple of cycles. Another thing that I think is different, and this goes back to decline rates, and which are less visible, it's kind of a question of doing your homework, and also and the more visible project cancellations and deferrals, both in this country and around the world. Again, simply this country acting first, but everyone else, as we see this steady stream of cancellations. The big thing when you go around nowadays and talk to producers, our clients, the new mantra is living within cash flow. It's totally been turned on its head. For the last several years, basically the dynamic in most North American producers, and this goes for shale and also for heavy production up in Canada and so forth, the logic essentially around the boardroom table was, okay, let's pick a production target and then figure out how much money we need to spend in order to achieve that target. That was the old days. Now, totally been turned on its head. Given our price forecast and given our production profile, what do we think we can be very confident in our cash flow? So what are those numbers? And then, given that cash flow, what is the best way to spend that money in order to manage our declines, or if we can try, hold it steady, maybe even increase a little bit. So that is a huge, huge turnaround. And I think they're not calling it the same thing, but when you look at the recent stream of earnings reports from all the major companies around the world, and they're all testing projects now at $60. They're in effect doing the same thing. They're explaining it a little bit differently, but so I think that's really important as well. I will stop there.
So I'll put on my oil hat now. And just two interesting features, building on what Michael said, is that, so what's different this time, physically in the market than in the 80s, was that you don't have any spare capacity. And so this was Sarah's point, that you now have moved that spare capacity into storage, and are the pricing relationships right? And instead of having one, or if you're in a functioning OPEC world, 10 companies that control that, you have a lot more people that, for different reasons, are going to decide whether to release that storage into the market. The other thing that was very interesting about this time was the rapid transmission of price. This is how quickly it fell, where it took months before, and it was or even years, and the price discovery was so rapid. And that there used to be this idea that if there was something around the corner coming, you'd see it, they would gradually come into the market. And I think that may be a new feature, just that change happens very quickly, and it gets priced in very quickly.
We've got about 10 minutes left. I want to get some questions from the audience. I'm going to have one here, and then, sorry, I'm just trying to see who we can get to, and then one right back there, sir. I don't know where the microphones are, so, right there, there's Dave. Sorry, I can't see, there's a lot of sun coming from
So to try to integrate across the panel a little bit, one of the comments were about how perceptions is one of the major things to help drive prices. If COP21 comes out with actual strong statements, with some commitments, with some tackling the supply side, how might that affect perception within the market on the producer side or otherwise? How does something coming out of Paris significant on climate affect oil market?
Hi, Mark Nichols, Ceasefire Advisors. Could I ask the panel about Brazil? How do you see Brazil over the next couple of years? That country's had a tremendous commodities boom. It's also facing a political crisis as well, with the corruption investigation at Petrobras.
Herbert Regenbogen. Energy security in terms of the new type of regenerative capitalism, financial tools, risk assessment used by companies like reinsurance, Swiss reinsurance. In terms of modules, microeconomics being related to the impact on ecosystems. An enormous game changer in the entire analysis of econometrics, which is now being implemented by reinsurance companies, either with risk assessment and the capital portfolios beginning to be offered in New York by hedge funds.
Thank you. And I'm going to add one on top of that, and we'll keep our answers really tight, guys. Many of you mentioned geopolitical dynamics and that geopolitical question mark. We had a fairly significant geopolitical event over the weekend that is reshaping the way that people are thinking about this. I'm not asking you to foresee a geopolitical event that could make your supply and demand fundamentals shifted or not matter as much. But I do, if anyone has some helpful thoughts about how energy market analysts are thinking about a particularly geopolitically difficult time, and how to think about that kind of risk in light of the kind of market we've got today, that would also be fine. So, Michelle, what we ended.
Sure, so I could touch a little bit on the COP21 market issue and then perhaps a little bit on your last question on geopolitics. So look, I mean, I think that really the market, the initial market impact, which will be, any market impact will be probably very short-lived and depends on what else is happening that day, will depend on the spin that comes out of Paris, right? If there is a very strong, unified message that comes from the US, from the Europeans, from China, from India, frankly from Saudi Arabia, then you might get people paying attention. Wait a second, they're finally agreeing on this, it's not just hot air. You might get a little blip, but nothing that's going to be right now pretty significant. I think that internally in companies, it's obviously a flag for them if they haven't already begun to really stress test their portfolios and think about how amidst this risk and obviously all the other risks that are going on with prices, how do they handle this business moving forward? On the geopolitical events and how they affect oil markets, it's very interesting. There was this period of time, I would say, in the 2000s and really through almost last year, where increase in terrorism, increase in extremists was directly correlated with a bullish oil market, right? People automatically thought that if you had problems in the Middle East, that it was going to manifest itself in supply, and that might still very well be the case, but there are several things happening now that really moderate that. You have obviously a tremendous amount of supply where it will take some really big supply event geopolitically to clean it up. The second is that when you have these extremist groups targeting a lot of soft targets outside the Middle East, in some ways there's a bigger portfolio of things that they can go after, that it doesn't just concentrate on the oil market, dissipates, at least in the near term, some of those risks. And you frankly have, according to public reports, some of these groups now involve themselves in the oil sector. And so it's a lot more nuanced on how you try to correlate and apply the risks of this growing extremism with the oil market.
I will have a short answer to all of them, I think. On the COP21, I was struck by, I believe it was just last week, maybe the week before, BP made a fairly detailed, I think their chief economist made a speech and was directly talking about a type of world where, what if, we do have, peak demand and the oil is, and gas and hydrocarbons in general are left in the ground. And I think if we do have a successful agreement in Paris, to me, I don't think there'll be a short-term oil market reaction, but if the oil markets start to see many more big companies make similar speeches to BP, I think then people will sit up and take notice. On the geopolitics, again, as far as supply disruptions, the markets are pretty laid back when you have inventories crazy high like they are now. The markets start to get twitchy when we're in a much more balanced market with lower inventory. So that's not going to be the case for a couple of years, I don't think. Also worth mentioning on the demand side, unfortunately, if you think back to 9/11 and if we do get more events like just happened in Paris, that is the sort of thing that kills consumer confidence and that can tip us into a recession. And on Brazil, all I can say is Petrobras, I think last week mentioned that they're thinking of cutting budgets even further. So we simply don't believe their production forecast with that, which I think is at 165 KBD growth each year. As I mentioned earlier, we're looking at 100, and maybe even that's too high. They have oil; it's about that they have the money.
So in terms of Paris, I think that, again, the way the market works is that it's not going to be necessarily pricing in anything different on the day that an announcement happens. No one's going to be buying and selling calendar strip 2020 prices, 2020 contracts based on what comes out of Paris. I agree. I think that it's going to make a difference if you start to see a bunch of companies saying, look, this is how we look at it differently. It's going to make a difference if you start to see Saudi Arabia say, look, this is how we look at the world differently now that this agreement has been reached. And I think those are possibilities that will have an impact on fundamentals. But it's hard to say that those will follow from an announcement on that day. In terms of Brazil, I agree. We've reduced our output expectations for Petrobras, as everyone has. Just 2 years ago, the IEA had a very high number out to 2020 and 2025. We had discussed that a lot when I was at the IEA, and our medium-term forecast continued to have a very conservative outlook. So I think at this point, the issue is actually on the demand side. For Brazil, Brazil is going to enter a recession based on the estimates of our economists, as China's appetite for commodities grows, as their appetite for iron ore and other raw materials from Brazil starts to decline. That is going to have an effect on their economy. And in a country where they are consuming a lot of oil and diesel for industrial use, that's going to have an impact on the demand side, arguably more in the short term than on the supply side. In the short term on the supply side, it's one of these issues where the company is still living in a $100 world. So they're more and more incentivized to get those projects over the finish line because they're the only sources of incremental revenue that they have. So we're going to see incremental supplies from the pre-salt come on, and those are going to add 150,000 barrels a day in the next 2 years. And their ability to do that hinges on getting that extra supply out. And I don't think I have anything else to add in terms of the overall consumer confidence issue in terms of and extra jet demand. We saw this, in the aftermath of SARS and 9/11 as well. So it is possible.
Okay, Sarah, so this is great. I think the question on Brazil has been answered, so I'll answer a different question. How about Mexico and Argentina and Canada? How about that? Well, I mean, the story with Brazil is low prices make it really hard to develop new deep water projects. And if you are struggling to come up with contract terms that attract foreign capital in, that's the issue there. So Mexico has just gone through a huge energy reform to try to draw capital in. They too will suffer from the issue of low prices. But the opportunity set in Mexico actually could be an interesting one for companies to get involved in. Argentina, what I find interesting there is it's probably outside of the United States and Canada, it is the one other country that seems to be taking a run at shale development and in a big way, and it'll be fun to watch how that develops. So moving on to the other question that I'd like to address, the one about energy security and the environmental aspects of energy security, how insurance companies might want to look at both environment and other issues as part of what they do. I think is an interesting one. Historically, energy security was related to import vulnerability. How vulnerable are you to a loss of imports? And I think we've kind of moved away from that definition more towards one that includes environment. I would even say weather. I mean, the biggest energy security event that we've had here in the United States was Hurricane Sandy and what it did to the fuel and electricity infrastructure in the New York, New Jersey area. Other things, demand, GDP. I mean, I think we're looking at this week, in fact, electric utility executives are going to be doing a gaming situation to say how could they respond if there were threats to the grid in the United States. And those sorts of questions, I think, are going to become much more important. It seems as though we're moving away from the security of supply and imports and more towards the security of distribution of energy. And I think that that's going to be an interesting challenge for everybody that's involved in that. Thank you.
We've reached our time, and I know we've got many other sessions to go this afternoon. I just wanted you to please join me in thanking our panelists for being here today.